Current live trading data for Plug Power Inc., ticker symbol PLUG, indicates the stock is sitting exactly at $1.98 per share. The market is currently closed, reflecting the final movement from the last active session, where the price dipped by roughly 0.25%, shedding half a cent. While a half-cent drop sounds negligible, the context here is everything. You are looking at a stock that once commanded a valuation north of $60 during the pandemic frenzy, now fighting to hold the line above the psychological barrier of $2. The intraday action shows a flatline pattern, a stalemate between exhausted sellers who have already exited and tentative buyers terrified of catching a falling knife. Most investors look at this chart and see a cheap stock, a bargain bin lottery ticket on the future of energy. That is the expectation, that hydrogen is the fuel of the future and buying Plug at under $2 is the financial opportunity of a lifetime. The reality, however, is far more brutal and complex. You are not looking at a standard buy-the-dip scenario. You are staring at a company currently navigating a liquidity minefield that could determine whether it survives the next 12 months or faces restructuring. The gap between the retail investor's dream of a green hydrogen utopia and the cold, hard math of Plug Power's balance sheet has never been wider. Let's talk about the immediate catalyst that is flying under the radar for the average Robinhood trader, but is screaming sirens for institutional capital. It involves the Department of Energy's $1.66 billion loan guarantee. For months, this loan was the bullish thesis, the government backstop that proved Plug Power was too big to fail. But recent filings reveal a terrifying pivot. Plug has warned that it might pause or suspend activities related to this loan. Why would a cash-hungry company pause the very lifeline it needs? Because the conditions attached to that money require spending capital they simply do not have right now. This is a classic catch-22. To get the government money, they need to spend money to reach milestones. If they stop spending to preserve cash, they lose the loan. If they spend the money to get the loan, they might run out of cash before the funds unlock. This is the tension defining the current price action at $1.98. Common ground suggests that Plug Power is the leader in the hydrogen space. They are. They have the most electrolyzers deployed, the biggest name recognition, and partnerships with giants like Amazon and Walmart. But the contrarian take you need to consider is that being the first mover in a capital-intensive industry is often a curse. You burn the capital to build the infrastructure, and then competitors come in later with better technology and lower cost once the market is established. Plug Power has been subsidizing the hydrogen economy for years, selling fuel cells and hydrogen often at a loss to build market share. The market is now asking if they can ever flip the switch to profitability before the cash runway ends. Analyzing the recent market movement, the stock has been trapped in a tight consolidation range between $1.80 and $2.10. This lack of volatility is deceptive. It is not stability, it is compression. Volume has been drying up, which often precedes a violent move. When we look at the institutional activity from the last quarter, we see net selling from major funds who are risk-off on speculative growth stocks in a high-interest rate environment. The daily swings are dominated by high-frequency trading algorithms scalping pennies, while long-term accumulation has paused, waiting for clarity on the accounting front. Financially, the picture from the third quarter of 2024 was a wake-up call. Revenue came in at $173.7 million, missing the consensus estimate of over $200 million. That is a significant miss. But the scarier number is the earnings per share, which came in at a loss of 25 cents. The company is still burning cash to keep the lights on. The gross margins remain the critical sticking point. For a long time, Plug was essentially selling dollar bills for 80 cents, losing money on every unit of hydrogen delivered. They have improved this with their new plants in Georgia and Tennessee coming online, reducing the need to buy expensive hydrogen on the open market. But the margins are still not where they need to be to support the current valuation without external capital. Let's step back and look at the business model itself because it is fascinatingly ambitious. Plug Power aims to be a vertically integrated hydrogen ecosystem. They do not just want to sell you the fuel cell for your forklift, they want to sell you the electrolyzer that makes the hydrogen, the liquefaction plant that transports it, and the storage tanks that hold it. It's a massive, capital-heavy vision. Their core business historically has been material handling, replacing lead-acid batteries in forklifts with hydrogen fuel cells. This works brilliantly for companies like Amazon because hydrogen forklifts don't need to sit at a charging station for hours. You refill them in 2 minutes and they're back to work. That efficiency gain is real. However, Plug is trying to pivot from just forklifts to becoming a global energy producer. They're building gigafactories to mass-produce electrolyzers, machines that split water into hydrogen and oxygen using electricity. The problem is physics and economics colliding. Green hydrogen, made from renewable electricity, is currently expensive. Gray hydrogen, made from natural gas, is cheap but dirty. Plug is betting the farm on green hydrogen coming down in price, but with interest rates remaining elevated, the cost of building the wind and solar farms needed to power those electrolyzers has skyrocketed. This macroeconomic headwind is pressing down on the entire sector, not just Plug. Now we have to address the political elephant in the room. The recent U.S. election cycle has introduced a massive layer of uncertainty. The Inflation Reduction Act, or IRA, includes the 45V tax credit, which offers up to $3 per kilogram of clean hydrogen produced. This credit is the difference between profit and loss for Plug Power. With the political landscape shifting, there is genuine fear that these credits could be rolled back, modified, or made harder to qualify for under a new administration that favors fossil fuels over green alternatives. If the 45V credit is diluted or repealed, Plug's path to profitability gets pushed back by years. This regulatory risk is being priced into the stock right now, keeping it pinned under $2. This brings us to the future outlook and the scenarios you need to watch. The bullish case is that the Georgia and Tennessee plants ramp up flawlessly, slashing Plug's fuel costs. Simultaneously, the Fed cuts rates, making capital cheaper, and the DOE loan finally comes through, securing the balance sheet. In this scenario, a short squeeze could send the stock back to $5 or $6 very quickly. The bearish scenario is that the cash burn continues, they fail to secure the DOE loan, and they're forced to do a massive equity offering, diluting current shareholders significantly, or worse, facing a liquidity crisis. Speaking of shareholder sentiment, I want to hear from you. Do you think the government will maintain the hydrogen tax credits in their current form, or is the green energy subsidy era coming to an end? Comment below with green light if you think the subsidies stay, or red light if you think they get cut. Now we must discuss the short selling activity on this stock because it is critical, actionable information. Plug Power is currently one of the most heavily shorted stocks on the NASDAQ. Short interest is hovering around 23 to 24% of the float. This is incredibly high. It means nearly 1 in 4 shares available for trading has been sold short by someone betting the price will go down. When short interest is this high, the stock becomes a coiled spring. If positive news hits, like a finalized DOE loan or a surprise profit beat, these short sellers have to buy back shares to cover their positions, which drives the price up, forcing more shorts to cover. This is the mechanics of a short squeeze. However, don't just blindly buy hoping for a squeeze. You need to look at the days to cover ratio, which is currently sitting between 2.6 and 3 days. This measures how many days of average trading volume it would take for all short sellers to close their positions. Anything over 5 is a red alert for a squeeze, 3 is moderate. It suggests shorts are comfortable right now but could panic if volume spikes. You also need to watch the borrow fee. This is the interest rate short sellers pay to borrow shares. If you see this fee spike on your brokerage data or sites like Fintel, it means shares are getting hard to find, which is often a precursor to a rally. Conversely, if the borrow fee is low, it means there's plenty of liquidity for bears to keep hammering the stock. Retail investors need to be wary of fail-to-deliver data as well. High FTDs can indicate that there is naked shorting or administrative strain in locating shares, often signaling a manipulated or highly stressed equity. If you are in this trade, you are playing against sophisticated algorithms that hunt stop losses. The strategy here is not to use tight stops that get wicked out by volatility. Instead, monitor the institutional ownership filings. If you see big players like BlackRock or Vanguard increasing their stake despite the price drop, it's a signal they're playing the long game. If they're trimming, you should be worried. Social sentiment on platforms like Reddit and X are currently a war zone. The bulls are posting rocket emojis and citing the long-term hydrogen total addressed market, which is in the trillions. They argue that hydrogen is the only solution for decarbonizing heavy industry like shipping and steel. The bears are focused on the cash burn incinerator narrative, mocking the lack of profitability after decades of operation. This polarization is healthy for a trading range, but dangerous for a breakout. You want to see sentiment shift to uniform despair before a true bottom is formed, or uniform euphoria before a top. Right now it's mixed, which aligns with the sideways price action. Looking at the technical specifically, the $2 level is the battleground. It was support, now it's resistance. The stock needs to reclaim $2.10 on high volume to break the bearish trend structure. Downside support is thin. If it breaks $1.80, the next technical floor is the 52-week low around 69 cents. That is a massive drop. This highlights the asymmetry of the risk right now. One aspect often overlooked is the global angle. Plug is not just a U.S. story. They're expanding into Europe with joint ventures like the one with Renault for hydrogen vans and infrastructure projects in Spain and Finland. Europe's energy crisis has accelerated their hydrogen roadmap faster than the U.S. in some respects. However, these international projects also require capital expenditure. The currency risk of a strong dollar impacting their international earnings is another layer of complexity to watch in the quarterly reports. The going concern language that appeared in financial filings last year was a major blow to confidence. While management has expressed confidence they have resolved this immediate threat through at-the-market equity offerings, basically selling shares to raise cash, the stigma lingers. Every time the stock drops, that fear resurfaces. You need to watch the next 10Q filing like a hawk. If that language disappears completely and cash reserves stabilize, the stock will re-rate higher instantly. If it remains or intensifies, the $2 level will not hold.